Good afternoon, everybody. There's a couple more people signing in. I can actually see them logging in right now, but we're going to go ahead and get started. Nobody cares about the title slide, I guess, right? So today's topic for the March Apella Academy is a pretty popular one. We get asked quite often about long-term care insurance, the need for it, how it integrates into an overall financial plan. Before we dive right into the presentation, for those of you who are new to Apella Academy, essentially what Apella Academy is a bi-monthly webinar where we discuss a wide-ranging variety of topics in the area of financial planning. Past ones have included things like cybersecurity, college planning, Medicare planning. So really the intent here is to educate and inform our clients, their family, friends, their neighbors. We want to have the most educated and up-to-date client base because an informed and educated investor makes better decisions, they stick with their financial plan, and they're less likely to make a poor choice during volatile market times. So we have a full slate of these for the remainder of the year, live, recorded, in person. So keep an eye out for future topics. Also, if you have suggestions for other topics you'd like to see us cover, never hesitate, reach out, call, email, and submit your requests to us. So we are recording this webinar, so if you do find it valuable or you have to cut out early, we'll be able to share this with you in a couple of days. Once it's live up on our website, we'll email you. And at that point, if you find that you think somebody else that you know would take some value from this, feel free to share that with them. Just so you know, on the ApellaCapital.com website, there is a section for education, and all these things fall under the video section there. There's a lot of information there. So if you haven't seen any of these before, please go to our website, ApellaCapital.com, and check those out. So today's topic, as I mentioned, is long-term care, one of the more popular conversations and least favorite things that people like to discuss, but it's obviously an important one. And joining me today is Peter Leppones from Life Plans of New England. Peter is a area vice president of marketing. He's a certified financial planner. I've known Peter for about 15 years now. Him and I go way back. He has also helped me with a lot of my clients in the financial planning process in the area of life insurance, long-term care insurance, and even disability insurance. Peter's has a long track record of being an expert in the field of insurance. So I thought, it's always important to bring in an expert opinion when something like this is being done, because we want to have all the answers that we can possibly have for you. So, Peter, thank you for joining us today.
Thanks for having me, Jason.
So, I guess the first thing that we should do here is just jump right into the crux of it. Really, what is long-term care? And today we're going to cover a bunch of different topics here. And it really starts with the fact that most people envision themselves living a long life in retirement. They plan through their entire working life to savor this perfect retirement plan with their family and their friends. The idea of retirement is a little different, but at the end of the day, we want to spend it doing the things that we love. And as part of the process, it's important to understand the impact that long-term care and health issues play in that overall plan. So, the first thing that we really need to consider is the financial impact. And, medical sciences have made great advances over the years, and the reality is while we're all living longer, it also increases the likelihood that you might have health issues later in life, right? Living to 90 and to 100 doesn't necessarily mean you'll be healthy for all of those years. And it can take decades to accumulate the amount of assets needed to live a comfortable retirement, and only a year or two of a health issue to decimate those savings. The other thing that's important to understand is really when you or someone you know gets ill or has a condition, it can take a pretty serious toll on that caregiver. Many of us have had a parent or a sibling or a neighbor who's provided care for somebody else as maybe they've gotten sick and had to pull back on the amount of things they could do on a daily basis. And, providing care to someone is obviously a very compassionate, loving thing to do, but it's an incredible burden on spouses and children and other family members. It can also create a pretty significant emotional, physical, and financial strain for those caregivers. On top of that, it's just important overall to have a plan, right? We tend to put off decision making for far too long, and waiting to address this specific question and part of your financial plan can be pretty darn expensive. So if you think, well, maybe I should self-insure, but maybe I need long-term care insurance, it makes more sense to start having that conversation now rather than waiting much longer, because we'll see very often, you'll probably hear one of us say that you're never healthier or younger than you are today. So with that being said, one of the things that probably is the best place to start is with just a basic definition of long-term care, which is an ongoing assistance with some of the more basic activities of daily living. And they're listed here. Peter, I think where we see some of these things pop up, these are probably some pretty common things that we've seen family and friends have to deal with over time. So talk a little bit about long-term care and how it addresses these items.
Thank you, Jason. I think one of the things to really keep in mind is that that definition of long-term care, it's pretty broad. I think there's maybe an image that we all have of us needing long-term care, and I'm going to be in a nursing home in a wheelchair and completely incapable of doing anything for myself, needing around-the-clock care. Well, that's an extreme, but if you are unable to get yourself out of bed in the morning and you're unable to feed yourself, that's considered a long-term care situation. If you have a policy, you could technically go on claim by there's 6 activities of daily living listed there, those 6 bullet points. If you cannot complete 2 of those, most long-term care policies out there will allow you to go on claim. The nice part is most long-term care policies allow you to get that care at home, because if you wake up one day and you can't do 2 of those 6, there's not many people out there that are raising their hand saying, send me to a nursing home. You want to stay as home as long as possible, where you're comfortable, where your family is, where your friends are, and you'll need assistance. And fortunately, a lot of the policies out there will help to cover that.
In those 6, it's 2 of those 6, and then underneath that you'll see, or you must have been diagnosed with Alzheimer's, and it should say, or dementia. So these cognitive impairments, really, you only need Alzheimer's to qualify, and obviously that's a completely different boat of issues, but you don't have to have Alzheimer's and difficulty dressing. It's Alzheimer's stands alone.
Correct. The example I use, Ronald Reagan had Alzheimer's for 10 years. My wife's grandfather had it, and he was completely healthy. He had it for 6 or 7 years. He was able to do everything. It decimated his memory.
So as you start to look at these things, all of us have a hard time thinking of ourselves at some point in the future not being able to do any of these things, or God forbid having Alzheimer's or dementia. But the reality is these are pretty basic everyday functions, which once you are not able to do them, somebody else has to come in, or you have to go somewhere else, right? And that's the importance of planning now. So, as we start to think about long-term care, Peter, you mentioned actually care in the home, right? And I think we have a misconception that long-term care only takes place in a nursing home, and we're going to talk about these in a second, but that's not the reality of it.
No, definitely not. And again, it's personal choice, because very few people want to be in a nursing home. You'd want to be either at home or an assisted living type of facility, where there's care that's closer if you need it. Alzheimer's adult daycare comes in, and that's really big, because the person, if you've got a spouse with Alzheimer's, there's a healthy spouse at home, that adult daycare really gives that healthy spouse really a break, and because they're dealing with a lot too, the emotional impact and physical impact on that healthy spouse is tremendous, and this gives them a break to help them lead their life, and takes that the ill spouse and gives them a place to go during the day where they can be interactive and be doing different things away from the home.
If we take a step back from these, just by pure definition, there's really two types of care, right? There's skilled care and custodial care. Skilled care is really when intensive medical attention is needed, right? Generally recovering from something after a hospitalization, less than 100 days. Now, that's normally covered by private insurance and Medicare when certain conditions are met. Custodial care is really non-skilled care. This is for patients with chronic conditions where they're not really expected to recover. And that's, where long-term care really starts to kick in. And that's not covered by health insurance or Medicare, right? A common misconception is that Medicare will cover these issues. That's not the case. Custodial care must be funded by other means such as personal savings, right? And that's what we're talking about, trying to preserve those, a lifetime of savings. So for a lot of folks, care starts in the home, right? Home care is normally provided by an unpaid family member, or maybe a home health aide comes in. There's an aging in place movement, right? Retrofitting your home to allow people to stay in there for a much longer time period. As Peter just mentioned, you move into something like an adult daycare center. And that's really to provide that person who's doing the primary caregiving, the spouse, a break, right? To be able to go out and do whatever it is they need to do, and to feel comfortable that their loved one is being cared for. Next is the assisted living, continuing care retirement communities. Now, these generally provide for a fairly large range of services and, can match up to any desired level of independence. These are more formal commitments, right? These are contracts to move into a facility. So these aren't things that are very cheap either. Most of them provide meals, do things like housekeeping, maybe transportation to and from shopping or activities. And they do provide assistance with some activities of daily living as well. There's also a lot of social and recreational activities. Now, normally in general, you have to pay out of pocket to live at one of these places. And there's usually upfront fees, contracts that need to be signed. Some of these, there's a bunch of them in Connecticut, New York, that are pretty darn expensive, right? As high as $400,000 just to get into some of these facilities. And then it gets to things like nursing home and hospice, where this is, I guess, the traditional view of long-term care, the end of spectrum care choices here. Nursing homes, these are really the last resort. And so it's important to kind of remove some of the bleak feelings we have about long-term care. There is that movement to be able to stay in the home longer and to have care provided outside of places like this. But for many people, that's not an option. And we'll look at some statistics that really speak to that in a moment. So at the end of the day, who really needs it? Right? And Peter, this is a pretty staggering statistic here, right? 70% of people over the age of 65 will need long-term care at some point during their lifetime.
Yeah, and you look at that and say, "Holy cow, that's a lot." What I think is also kind of put in there to maybe sort of soften the blow of seeing that number is, well, if you had a knee replacement done, and it's quite common these days, afterwards you're going into a nursing home for rehabilitation. You can't walk through your house. You need to be there to strengthen that knee. And while you're there, you've got a room and you need people to help bathe you and change you and get you fed. So that is put in there. And again, that's long-term care means a lot of different things. It's a very, very broad definition with that 70%.
So there's really 5 factors that affect the possibility that you're going to need care. A couple of them we touched on already, and we're going to touch on them again probably a few more times in this presentation. The big factor is age, right? I mean, the gist of it is the older you get, the more likely you are to need care, right?
Yeah, and you had referenced it earlier, the medical technology, which has been fantastic, but the heart attack or the stroke that was killing people even just 10 or 15 years ago, you're now surviving that, but you're coming out of it and you don't have the full capabilities that you used to. And you're going to find yourself or could find yourself in a situation needing care. And that's only going to get worse as you get older.
Gender's another big one. I think we know that women historically have outlived men, and when you look at the numbers, it's about 5 years on average. So they're more likely to have health issues just based on their additional longevity, but they're also more likely to be alone at the time that they actually need care. So gender is a pretty important factor in whether you need it or not.
Yeah, definitely. The whole thing with having a spouse or partner in the home is a huge factor in helping out. And then all of a sudden, if that spouse or partner is now gone, it can make it very, very difficult. And women, when we look at sort of the pricing from, I'm dealing with life insurance and long-term care. I'm always used to it costing more for men for life insurance because they're living less. Women have a longer life expectancy. The opposite is true for long-term care. It's more expensive for a woman to have it because there's more of an instance of a claim with females because they are living longer. They tend to be the survivor.
The other thing, one of the other things is disability. That chronic illness or disability that, like Peter just talked about, that's something that can carry on for quite a while and result in needing care for a long period of time. That last bullet point there, is not that surprising. What's interesting though is the middle bullet point, where on average 8%, right, which isn't a staggering number, but when you look at the age demographic, it is interesting, right? Between 40 and 50 could require some long-term care service, and that's a double-edged sword.
It really is. It's because you're in your peak earning years, so not only are you in a situation where you need long-term care, and if you're 50 and you have some type of stroke or severe illness, where now your spouse is there to have to take care of you, but you're also in all likelihood have children, high school, college aged. You're in your peak earning years. And now you've got not only your care to worry about day to day, but where's your income coming from in order for you to put those kids through school and to retire. So that's a really staggering statistic there.
I think we all think about health when in your current health status, but we tend to personalize it, right? If I have a poor diet or I'm out of shape or I know I have a chronic condition, that's obviously going to impact it, but we really need to take family history into consideration as well.
Yeah, when you're looking at family history, the family history of Alzheimer's or dementia can play a role into getting a long-term care policy. It's not going to prohibit you from getting it, but because that family history is there, there's an additional risk for you perhaps getting that, and that's going to be factored into the pricing.
And the last one's often overlooked, right? If you live alone, well, who's going to take care of you? And that's a pretty big concern, because it's not unusual that, you get married, you raise a family, your kids move out, go to school, get married, and they leave the state. They're not near you anymore, right? So who provides that care if you're living alone? And that's that for a lot of people, that's maybe the biggest concern, right? They don't want to put that burden on their family to come home and take care of them, or for them to have to leave. So understanding like your living arrangements now and what they might be in the future is a pretty important component when deciding if, in fact, you need some type of coverage for care. So as we drill into just some basic statistics about long-term care insurance, some of these numbers are pretty spot on with what you'd expect, and some of them are somewhat surprising, right? 8 million people here in the U.S. experiencing difficulty with self-care, the activities of daily living that we just talked about. That's a pretty big number. If you look at the next line item, 13 million individuals, adults, who experience difficulty living independently. Now, I think our traditional sense of what long-term care is that means those 13 million people need to be putting into a nursing home. That's actually not the case.
Yeah, it's those activities of daily living, the eating and the dressing yourself. If you can't do it safely, if you can't get your shoes and socks on and button your shirt without falling down and hurting yourself. And it is dangerous. Falls are a huge thing. And if you're falling down, you're eventually, it's going to lead to worse things like breaking hips, breaking other bones. So it's what you tend to see is it's a slow movement progression downhill. It starts with the one activity of daily living, two, and then eventually you're getting 4, 5, and 6, and you will at some point, in all likelihood, you're going to require more and more care.
The numbers, I guess, when you start to look at the percentage of men and the percentage of women who will need it during their lifetime, it's essentially a coin flip for men and a little worse than a coin flip for women. And that goes back to the longevity discussion that we were just having. Women outlive men by on average 5 years. So statistically, you are more probable to need care over the course of your lifetime. 8.5% of individuals over the age of 65 who spent at least one night in a nursing home in the past 2 years. That's from a study from 2010. But if you look at that number increased 40% from the preceding decade. So once again, I think that speaks to longevity and the idea that we're living longer. We're outliving our parents, our grandparents, and our great grandparents. But how are we spending those last all those extra years? And it's not going to be in tip-top shape.
Right, and I think what's also factoring into that is you've got the baby boomer generation sort of aging and getting into that demographic, and it's becoming bigger and bigger. So you're seeing a lot of that in there as well.
Now, this is, we've harped on this a little bit, but it's important to kind of drill it in that you can get care in the home, right? And about 14% of people over the age of 65 who used some type of professional home healthcare service in the past 2 years, also from a study in 2010, and that doubled from the preceding decade. So it is becoming more commonplace where we start to see that staying in the home mentality. There's almost no discussion to be had anymore. That's how it should start. So as we start to look more at the usage numbers, back to women and men, 44% and 58%. The average duration of a nursing home stay, now that number is the 0.88 years and essentially 1.5 years, the average duration of a nursing home stay. That's probably a little misleading because that covers all age demographics at once. And, Peter, I think we've seen this plenty of times. We know that the older you are, the duration technically goes up.
Oh, definitely. And I think what also kind of you have to look at is, okay, so it is 0.88 years, let's say, but I would want to know what happened before then, because you didn't just show up at a nursing home one day. You had care at home for some amount of time. So we look at those stats and understanding that there was a need that is probably much greater than 0.88 years or 1.44 years for females.
The percentage needing more than 1 year in a nursing home, also spanning all age demographics. So for people in their 60s, 70s, 80s, and certainly 90s, the duration is going to go up on these things. And percentage of people needing more than 5 years in a nursing home, I think where we typically see that, and Peter, you referenced it earlier with even President Reagan, dementia, right? You can be perfectly healthy, have cognitive impairment, and live 10, 15, 20 years. It's not unheard of. So here's the big speed bump for most people, and it really boils down to cost, right? We understand that it's a chance that we're taking by not having it, but for most people, at least that we've talked to, cost is generally the number one reason why they don't have it. I think you'd agree with that, right, Peter?
It's a premium that we're going to pay, and if I don't need it, it could be something that if I've paid for and haven't used. If I die suddenly of a heart attack at the ripe old age of 90, was never ill a day in my life, I'm not going to use it, and all that premium is a waste.
So what we're looking at here is essentially national rates versus Connecticut specifically. So each of these different rows match up with the columns there. So to begin with, you're looking at the median annual rate in the U.S., and then in column number 3, what it would be specifically for Connecticut. And then we've got 5-year growth rates on each of those categories. So across the board, what you see is Connecticut is an expensive place to live, is an expensive place to be sick, and it is certainly an expensive place to die. So it's not surprising to us that Connecticut would be higher than national rates across the board. But where you start to really see the numbers swing is the assisted living facility, that 1-bedroom single occupancy, the nursing home semi-private. I mean, $80,000 versus $146,000. That is a pretty wide gap. And also for the private room. Interestingly, the growth rates on these things are, not out of pace with national rates. In some cases, a little less than. But I mean, the rates are so much higher. And Peter, I know you work with folks all over really the country.
Yes.
I mean, Connecticut is certainly top of the charts.
There's no doubt. Connecticut, New York, Massachusetts, New Jersey, sort of this neck of the woods. It's expensive. Now within Connecticut, if you're down in Greenwich, it's going to be very, very expensive, perhaps even bigger than the numbers we see here. But then if you were to say go to another part of the state, say like Woodstock, where it's a little more rural, you might find something a little less expensive. But needless to say, it is more expensive in the state than, say, if you were to go to down south and go to, say, Alabama or Florida or Mississippi, somewhere down there. It's going to be substantially cheaper. Sorry to interrupt, but another discussion that sort of comes up is a lot of people are retiring internationally. Maybe they have a home that they're sort of transitioning to, say, in Costa Rica, somewhere in Central America, or possibly even in Europe. And the cost of care down in Central America can be substantially cheaper as well.
And when you start to really look at those numbers, essentially just call it $150,000 for annually for the state of Connecticut. How many of us have saved our entire lives to get to $500,000, $600,000, $700,000 worth of accumulated savings in our 401ks and IRAs? If we get into our 60s and 70s and all of a sudden we need 3 years of care, that's $450,000 that is just completely wiped out of our pockets, right? So that $700,000 nest egg has been depleted in a matter of 3 years. And if you are only the first spouse to need care, what happens if both spouses need care? Or, worse yet, what if the surviving spouse lives another 25 years and has to figure out how to do so on far less assets than they planned for? So we talked about caregivers. So this kind of circles back to something that we mentioned earlier. This is really where it starts. And there's 43.5 million adult caregivers older than the age of 50 here in the United States. About 15 million of them provide care for somebody who has Alzheimer's or some other form of dementia. That's a pretty staggering number. Not surprisingly, though, 66% of those are female, right? And the average caregiver age is almost 50 years old. It's 48. So that's $450 billion worth of care delivered by unpaid caregivers. And 70% of those caregivers, right, those more often than not females in their mid-40s, have suffered work-related difficulties due to their caregiving, right? So their own finances, their own families suffer, their own health suffers. I think we see that quite a bit.
Yeah, and really, when you talk about having that, because it's life's busy enough, jobs and families and raising kids and just trying to do your own thing, and to now suddenly have a situation where you have either a spouse or a parent who's sick or ill and needs that care. They're really going to rely on you. There's a tremendous amount of guilt that can be thrown in, and then the emotional, the physical, and mental impact on that caregiver. It's tremendous. It's really a big issue out there.
So when should we start thinking about this? There's two big drivers of this decision, right? Age and health. You're never younger or healthier than you are right now. And these are two of the things we see influence policy premiums more than anything else out there: age and health. So, Peter, you do this all day long, every day, right? So you're constantly seeing people at 50, 60, 70 applying for these types of policies. and some of them being declined. And what you see here is what you would expect, right? The older you are, the more likely you are to be denied due to poor health.
And when we say poor health, the scope of that is pretty big. You could be 65 years old, 70 years old, and in great health, but if you need a cane to walk around because you have a bad hip or a bad knee, you're a decline for long-term care. I always use this example. I'm always saying the insurance companies look at everything from a health standpoint with a glass is half empty mentality. That if you have a bad knee today, well, tomorrow you're not going to be able to walk at all. And you're going to go on claim, right away if we put a policy in force on you. So they're always looking at it negatively versus, hey, you might have a cane, but you're perfectly fine with it. You go to your doctor, you're taking care of yourself. You just happen to need a cane because your leg isn't that strong. And you could probably live that way for the rest of your life. The insurance companies don't view it that way.
So, that's obviously an important thing to take into consideration. How healthy are you right now? If you've got something bugging you right now, but it's not a real issue, it's probably time to start thinking about that. Are things, do they tend to get better over time or worse? And that's, I guess that's the glasses half empty view that the insurance companies are taking.
Yeah, certain things they're really good about. I speak with people every day about health and what's their health like and medications and high blood pressure meds and cholesterol medications, things of that nature, very, very common. And as long as you're taking them and everything's under control, that won't be any type of issue.
So if you look at the same policy for somebody age 50 versus age 60, the person applying for that exact same policy benefits, it's going to be much less expensive for that 50-year-old than it is for that 60-year-old. And in that 10-year time frame, obviously you're much older, but there's a lot of things that can go wrong health-wise there as well, right? So, it's important not to get it too early, but it's also important not to wait too long. And we'll talk about what that kind of perfect little sweet spot is for applying for care in a moment. So there's really 10 questions that can impact your policy, right? What are the different levers you can pull to make the policy not only the best fit for you, but the right price for you? 4 of them directly impact how expensive it's going to be, and the others are really just important things to keep an eye on as you start to pick your policy and all the different bells and whistles that go along with it. The obvious one here, the one that has the biggest impact on premiums is, well, how much do you want in benefits? And we looked at what it costs in the state of Connecticut, and that's a pretty staggering number, right? If you want to cover 100% of that, it's going to be pretty darn expensive. So a lot of policies state it in daily benefit max or a lifetime benefit max. But Peter, this is obviously the number one thing that will impact how much an insurance policy costs.
Yes. So you start looking at to start over $100,000 benefit for, say, 3 years. That's what we usually would do, starting somewhere over $100,000, paying that out for 3 years. Those are 2 of the places we would at least start the discussion.
So obviously cover more expensive, cover less expensive. So it's the idea that you can get rid of all of your risk potentially, or you can hedge some of it. And we'll talk about that as well. How long will benefits be paid? This obviously is another big one, because the longer you want benefits paid out, well, the more expensive a policy is going to be. As you get older, for somebody in their 70s, the average stay in a nursing home over 2.5 years. So, most people, I think 3 to 5 tends to be what you normally see in terms of how long benefits are in a policy.
Yeah, and I think sort of the approach that you would want to take is, all right, we get a policy in place. Let's say it gives us a benefit of 3 years. The first couple of years of care that we need, in all likelihood, are probably going to be at home. We go back to that scenario where we become weaker and more frail, and the activities of daily living. We'll have our care at home first. The cost should be substantially less, and that's something you might even be able to self-fund out of some existing assets without really depleting things. But at some point in time, you're going to have to go into that nursing home. And that's where you'll want the policy to kick in, because the expense is going to go up dramatically.
inflation protection. Obviously, we know the cost of this type of care historically hasn't even remained level. It goes up over time, and I don't think there's any reason to think that won't be the case in the future. There's a lot of baby boomers waiting to retire over the next 17, 18 years, so we know demand will be increasing. So just give a brief definition of what inflation protection is on a policy.
It will take your benefit and increase it every year, because if you're buying a policy today at age 60, you're not going to be using that in all likelihood for a good 15 to 20 years. So the dollar that it costs today in nursing home care, it'll be reduced dramatically in 15 or 20 years. So we want to make sure that you've got that policy you're buying today is going to at least keep up somewhat with the increases for the cost of long-term care.
I think 3% is pretty normal. Somewhere between 3 and 5, I think, is generally the wheelhouse.
Correct.
So the elimination period, and this is, I guess, something that most people probably don't know the term, but essentially elimination period is just like a deductible. It's the period of time that you pay out of pocket before benefits kick in. We call it the self-insurance period. So the longer this period is, right, the longer you agree to pay, or the higher the deductible, think of it, the lower the premium you'll pay. And I think most policies have 90-day, right?
They can go from 0 all the way up to like 180. So 90 is where we sort of start, and then depending upon pricing, we can move that either way.
So, we talked a little bit about this earlier in the presentation. Skilled is normally, after you've had some form of hospitalization, and you might not need long-term care for that because you've got Medicare, or you have traditional health insurance. You had a hip replacement, you're going to be in the hospital for a little while and need rehab. Intermediate care, more of that assisted living facility, and then full custodial care, nursing home type activity. So what's covered? Now, most policies, I think, are I don't want to say generic in this area, but I mean, I think, Peter, you can speak better to this.
Yes, I think generic is the right term to use, because what will happen is you'll work with an agency, like, say, if you're getting care at home, like a companion and homemakers. You hear those ads on the radio and see them on TV all the time. So you'll have, maybe you don't need an RN coming in, a registered nurse to administer medication or things like that, but you do need someone to come in and help with light housekeeping, meal prep, getting you bathed. So that a bill would get sent to you, and then that's what you're going to submit to the insurance company. And it doesn't really matter that it was a registered nurse or just a home health aide. They'll cover the cost regardless.
So, I mean, it's important to really understand all the different levels of care, but most of these are fairly common at this point in time. I think the same is true for this, right? Most of these policies cover all of these things in some type of in-home care, daycare, assisted living, right?
That's correct. It's giving you a lot of flexibility as you're calling the shots as to where your care is going to be and who's providing it.
When are benefits paid? It says vary from policy to policy, and it's I don't think it's standardized yet, but pretty much everything we see is 2 out of the 6 or dementia, Alzheimer's.
When we're sticking with the major carriers, the Mutual of Omahas, the Nationwides, the really big companies, and that's strong financially with very good histories and track records. Yeah, you tend to see things are fairly similar. I see policies with a fly-by-night insurance company out of the Midwest, and maybe it's a fine company, but I just would not trust it because it may not cover everything. Just make sure we're understanding exactly what are the triggering events, and is it the 2 of the 6, as well as dementia and Alzheimer's.
Well, I think you raise a good point there, because one of the things that's important to state is no way, shape, or form are we suggesting you just search out one carrier. One of the great things about working with Peter, whether it's in life or long-term care, essentially we are and you are completely independent. We'll search out any policy from providers and present all the pros and the cons of each of those, but we're not beholden to one particular company. You can go out there into the marketplace and shop everybody.
Right. There's maybe 3 or 4 companies that we work with from an LTC standpoint on a regular basis, and we can quote all those and see, because one couple who's in their early 60s, it might be carrier A, but they get a couple of years older, it might be carrier B. Every carrier sort of has their strong suit and they're where they fit in strongly and look the best from a pricing standpoint.
Talk a little bit about what a non-forfeiture option is. I mean, we're probably digging a little too deep into the nitty-gritty here, but just speak to it if you don't mind.
Sure. A non-forfeiture is a rider that you can buy on a policy where if down the road with your policy you decide you don't want it, you haven't gone on claim, you're healthy, you just say either I can't afford this or it's not something we feel interested in keeping anymore. If you have a non-forfeiture option, you tell the company, I'm not paying any more premiums. What they will do is they will give you credit and give you a paid up policy. It'll be greatly reduced, but at least there'll be something there. So you're getting credit sort of for your premiums paid in the form of a paid up policy that if down the road you do become sick, even though you haven't paid premium, you'll have some form of coverage, albeit much less than your original policy.
Right.
And I think one of these things is there's you've really hit, Jason, on the main drivers. We want inflation. We want to make sure we've got, say, 3 years of benefit, as well as enough daily benefit to cover a nursing home in the area of the country you're living. We can start piling on different bells and whistles, which are all great. Just like with a car, hey, we get a stripped down model, it's one price, but we start adding the moonroof and the nicer stereo and the leather seats, the price of the car can go up dramatically. So the same thing is here with long-term care. We try and stay away from the riders, maybe talk about them, but as we add those on, they make the policy that much more expensive.
I think in most cases, the riders make the insurance companies more money.
Yeah, there are some nice things like a shared care benefit, for example. There are certain things, but there's a lot. We could add, every carrier has 6 or 7 different riders that we could add on, and you could easily double the cost of your coverage, easily.
I'm not going to spend any time really on this. Most of these, I guess, from a tax perspective, are what we would call qualified, meaning that if you do go on claim and you're in an assisted living facility, your benefits are not taxable to you as income, except perhaps in the rare case where you're getting this from a group employer-based policy. The premiums might be deductible, but obviously this is an area where I think in general terms your benefits wouldn't be subject to tax, and you can certainly talk to us specifically or your accountant about the deductibility of those premiums as well. And then, Peter, we touched on a few of these things throughout here, but there's a lot of other bells and whistles, right? And one of the great things about a lot of the carriers, if not all the carriers right now, when doing planning, oftentimes if a husband and wife or a domestic partnership decide that they're going to apply for long-term care benefits, if both of them apply and are approved, there's a pretty significant spousal discount.
Yes, for example, Mutual of Omaha offers a 30% discount for husband and wife that are both applying and then both are approved and both take the coverage.
So, obviously, if you're considering it as a couple, it makes sense to do it together rather than stagger them, I think, right?
Yes, because you can't have one spouse apply today and then have another spouse apply for 6 months and get the discount, say, retroactively. It would be 2 separate policies and they wouldn't give you that discount on either one.
So, those are like I said, the first 4 are the big levers that you can manipulate to control and have a big swing on costs. Everything after that's really important to understand in these top 10. This one right here are just some of the other ancillary benefits or things that you can tack onto it. But for the most part, a lot of these policies are going to be fairly standardized. And the gist of it is, how much can you afford? How much do you want to insure? And how can we match those things up to put you into the right policy for the coverage that you need, desire, or can afford. So there's a couple of types of long-term care insurance, and we think I think most people think of straight long-term care insurance, right? I'm signing up, right? I'm going to apply for benefits. I got my benefits, and I'm just going to pay a premium every single year. And if something happens, I get it. Kind of like car insurance or homeowners insurance. I'm just paying this premium every single year. Hybrid is somewhat new, I guess, to the marketplace. And I'll let Peter, you can talk to both of these. One of the things we saw really over the past couple of decades is people would apply for long-term care insurance, straight long-term care insurance, have it for a few years, decide that it was too expensive, let policies lapse. So insurance companies, always thinking, started to create these hybrid policies, which I'll let Peter discuss with you, in an attempt to minimize people forfeituring their policies. So Peter, why don't you take us through the difference between what a straight LTC and a hybrid LTC or long-term care policy actually is?
Oh, sure, Jason. The straight or the traditional long-term care, two of the areas that people may not necessarily care for. We had mentioned one of these before. You die after paying in for 20 years and never went on claim a day in your life. You die suddenly, and your policy's gone. Premiums are gone, and there's been no benefit paid to anybody. Number two. Policies, traditional or straight long-term care, the policies premiums can increase down the road. With some companies, it happens more than others. But again, if we're sticking with the bigger, stronger companies, we're not immune from that, but we wouldn't see it as, say, a smaller company that had underpriced the marketplace. So what the insurance companies have done to sort of address those two concerns is they now have policies that are based upon a life insurance contract, and we have a living benefit where the death benefit is used while you're living, and it's triggered by the same two of the six activities of daily living or the Alzheimer's and dementia. You actually start to spend your death benefit for long-term care while you're living. Some of them may have a return of premium as well. So if you ever wanted out, say, I don't need this for whatever reason, you can get your money back. So we've got both options here. Each have their pros and cons to them.
So just as an example, I have a hybrid long-term care policy with a $500,000 death benefit, right? Think of this as a life insurance death benefit first. I'm 65 years old. All of a sudden, I need care for whatever reason. I go into a facility, and I'm in there for 1 year, and I need $150,000 because I live in the great state of Connecticut. Essentially, the death benefit would be reduced by that $150,000.
Correct. There's a formula that's followed, and for most of them, it's like a 2% of your death benefit. So it'd be in essence $10,000 a month. So yeah, if you did need the $150,000 and then you died after needing that year plus of care, there'd be $350,000 of death benefit left that's going to go to your spouse or to your family.
So for a lot of folks, I guess it becomes an expensive proposition to say, all right, well, I'm going to buy life insurance right now at this stage of my life. But for a lot of folks, maybe they have an existing life insurance policy where, you could examine, does it make sense to switch it into this type of policy where maybe my other major concern of long-term care can be covered as well. Now, I should say that we don't often suggest that anybody go out there and switch around their life insurance that often, obviously, because a lot of things can arise from that, right? Not only premium issues and not being able to get insurance. So certainly don't cancel any insurance or let anything lapse.
No, what we can do is we can do a life insurance review. If you've got a policy, let's see what it's about, because you bought it for a reason, and you probably bought it quite some time ago, and that reason has changed, and that's what happens as we go through life. Is there something out there that we could do to improve upon that policy to meet whatever your changing needs may or may not be?
And obviously, most of the questions can be answered through a holistic financial plan. And the great thing about Peter and his company and the services that he's provided to us is that financial plan, the insurance portion of it, when he does the review, once again, he can go out there and find out what's available in the entire marketplace right now. It's not he's going to one provider and only searching out one option. You're going to all the major providers to really get an idea of what the marketplace has to offer, not just one company. So if you're interested in something like that, certainly you can reach out to us and we'd be happy to provide you with that service. There's no charge for an insurance policy review. In fact, we've got, I think, just a basic form and some information that we need. And then, Peter kind of does everything behind the scenes. So if you're interested in that, feel free to email me and we can start that process for you. So this all really boils down to, is long-term care insurance right for me? Do I need it? And we've covered a lot of these areas here, and some of the more obvious things are, well, how old am I? Right, the older I am, the more likely I'm going to need it. How is my health? How's my family history of health? How much have I been able to accumulate? Right, if I've got $50 million in the bank, or pretend I'm Warren Buffett, I might not need long-term care insurance. Why pay the premium if I can afford to cover myself, right? Self-insure. If I have no money saved, why would I pay the premiums? Because I don't have as much to protect, right? So there's a perfect little sweet spot of how much money you should have in savings to actually want to protect that, and that's a discussion that we can have as well. Your retirement income. That's obviously something you need to protect, but it's also for many folks a particular budget of, can I even squeeze a premium payment into my annual budget, because these things are and can be expensive. We talked about family history. Dementia tends to be a big one there. If you have a history of that in your family, it might not be impossible to get long-term care insurance, but it might be expensive when there's a family history of something like that. Where you are in the country certainly is a big factor. Connecticut being essentially the most expensive state for long-term care needs, and then it really gets down to some kind of questions that we get, right? Because everybody understands all that other stuff, but is it just something that keeps you up at night? Did you provide care for somebody? Have you seen it in your own family or your friends? Is it something that, boy, you're so worried about it? Explore the question with us, right? We're happy to take you through that process and let you know if it is a necessary conversation, if you do need it. And at the end of the day, being able to put your head on the pillow and know that your assets and your family are protected is a pretty important thing, a pretty important peace of mind. The other thing is, are you a gambler or you're a risk hedger, right? So you can cover 100% of your potential cost, right? That $150,000 that we talked about. You can cover none of it, or you can cover something in between, right? There's a hedge there. And we talked about those 4 levers that you get to pull to really adjust how much a policy can cost. Once again, the older you get and the unhealthier you get over time, it has a pretty large impact on cost and on premium. So it's important to really start to look at where you are today, your health, how much risk you're willing to accept or transfer, and then reach out to us, and we'll be able to kind of walk you through that process. Now, speaking of process, Peter, maybe it's a good idea that for somebody who hasn't applied for any type of insurance over the course of their lifetime, if Bob Smith comes to me today and says, I'm really interested in protecting my assets or purchasing long-term care insurance, what does that process actually look like for him?
So we would obviously would start out with, well, let's get some proposals together and figure out which one makes sense. Is it a traditional plan? Is it a hybrid plan? Is it maybe a little bit of both? We'll look at really what the needs are and what are the concerns, because it's going to be different from person to person and family to family. It would then involve, once we determine the approach, taking an application and going through the underwriting. And the underwriting will consist of usually a phone interview, as well as the insurance company will ask for medical records from their physician. And then once all of that is in, we'll then get an offer, and then we'll come back and say, okay, we have the offer, and does this plan make sense? And we'll get the policy issued and then put in force.
So in terms of turnaround time, on average, what do you see from a person saying, I'm interested, to actually having a policy in place?
Well, the process from the time we take the application to getting a policy in place, you're probably looking at a good 2 months. Some of that lag time is from getting the records from the doctor's office. They sometimes can move a little slow on that, but you're looking at about 2 months. And up to that, the planning can take a couple weeks before that, because there's a lot of going back and forth and massaging the numbers and getting to the point where they have the right amount of coverage at the right premium.
And before we wrap up here too, and if while I say that here, because we're going to take you through one more quick thing, if you have questions on anything that we've talked about and you'd like to ask that, feel free to type them into the question box in that little bar that you have in the GoToWebinar control panel. That'll give you a couple of minutes while we wrap this up to start formalizing your questions, if there are any. But Peter, you were kind enough to run, I guess, what we would call just a couple of sample quotes from a provider for a male age 60, a female age 60, and if they were married, versus a male age 65, a female age 65, and if they were married. So if you wouldn't mind, for the audience, just kind of take them through what you did here and the results of it.
What I did was I ran a policy that will pay $8,000 per month, which is about $96,000 per year for 3 years, with a compound of 3% for inflation. I also put a shared benefit rider on there, which would allow one spouse to dip into the other spouse's pool of money. So that particular, and I guess I'll preface it with, I'm going to throw out numbers here, but again, these numbers may or may not apply, so I don't want to give anyone sticker shock here. There's all sorts of things that we can do to help with premiums. But for the 60-year-old couple, that particular policy was going to be $9,134. If we waited 5 years, the same exact policy on a 65-year-old couple is $11,264. So you're talking a difference of about $2,100 by waiting just 5 years. What's also not factored into that, a couple of things. Number one, there could be a change in health if we wait. Number two, products are constantly being repriced. And the trend with long-term care and life insurance, for that matter, is that it gets more expensive with the repricing for the same product year after year.
So, this policy obviously is, I guess, one of the more standardized things that we would show somebody up front, right? It would be, here's how to kind of hedge most of the risk that you have, cover both the husband and the wife, cover either of them if they need extra benefits, where you can borrow from one person's benefits. So in terms of the policy, there's still things you can do to have coverage if that sounds like, oh my God, I would never spend that much money on a policy, right? We talked about hedging some of the risk, right? Because with a policy like this, and we've had plenty of clients do this, maybe they say, all right, well, I'm not sold on this completely, but so maybe I want $4,000 worth of monthly benefit coverage. Maybe I want to add a 120-day policy, or don't worry about the shared benefit rider, right? So there's things that you can do to make this less expensive, for sure. So I don't want to say that there's a perfect policy for everybody, but there's ways to make it manageable and to at least hedge some of the risk, so that, to that second to last bullet point, you can put your head on the pillow at night and actually find some peaceful rest in the area of long-term care planning.
And big picture, I mean, it's when we start talking about what these policies do and the leverage that they provide. Yes, it's $9,000 a year, and that is by no means that's expensive, but each spouse here is getting almost $300,000 of long-term care coverage. So for $9,000 a year, you're protecting well over $500,000 of your own assets. So if we kind of look at it sort of just in a different light, there's quite a bit of protection here, and that $300,000 per partner or per spouse is only going to grow with the inflation.
So, also, what we don't have is what it would be if you had a hybrid policy, right? Because there's far too many complexities to run a lot of those that might make sense for an example to compare and contrast with the straight LTC. So there's also other options on the table outside of a policy like this, where if you have life insurance, or some of the concerns about never needing it or potentially needing life and health, having a policy out there that you're not sure if you even want to keep in force. There's a lot of things that we can take a look at for you as we help you navigate the very tricky waters of long-term care planning. At the end of the day, this is an integral part of your financial plan. Whether you end up with a policy or not, it's important to understand the level of risk and exposure that you have, not only from your own out-of-pocket costs, but the financial impact that it has on maybe a surviving spouse, or wherever you wanted those assets to go, children, charity. The impact is and can be staggering. So I'm just going to pause here for a moment. I'll see if there's any other questions into the text box here. I don't see any at the moment. If there are no questions, like I said, we are going to save this and post it to our website. We'll alert you as to when that's available, and we'll email that out to you. You can go back to the website at any time and review all of the other webinars that we've done up to this point. And certainly we appreciate you taking an hour out of your day to join us and to learn a little bit about long-term care insurance. So if you think of a question after the fact, don't hesitate to reach out via phone or email. Happy to answer any questions, and please feel free to submit any other topics or areas that you would like to see us cover in the Apella Academy webinar series. So I see a couple of you still hanging on the line. Like I said, I'll be here in the office. If you have any other questions, feel free to give me a call. Otherwise, once again, thank you so much for joining us, and I look forward to seeing you all again very soon.